Hi everyone, welcome to the December video of the Beginner's Guide to Algo Trading with PineScript. We're coming up on the last month here, and so what I want to do is go over kind of the foundation that we've built here and also discuss my current process. And I really want to emphasize process because that subtitle here of you don't learn how to trade, you learn how to become a trader is the main takeaway that I'm hoping to impose upon you if you've gone through all the videos and watched the series. If you've looked at the videos in this series and just thought, okay, these are just some interesting strategies, and you haven't taken these ideas and applied them to your entire workflow, your process, whatever you're doing as a trader, at least as an algo trader, then you haven't really captured the gist of what I'm trying to teach. And for that reason, if you understand what I've been trying to teach in this series, then you'll understand why in this final video, this is more of a process of what it means to be an algo trader and kind of what a lot of us juggle with in terms of our workflow and how we are able to just build strategies all the time. And so for you, take all of these ideas here, think about them, and for the next market that you want to explore, start applying them. Start looking at breakout strategies on them. Thinking about, how does this market behave in terms of breakouts? How does it behave when it comes to mean reversion? Whenever there's an extreme move or something that's an exhaustive move, is there a general trend following strategy? Is there any seasonality? Are certain days of the week, do they typically have a certain bias? Are there certain days of the month, especially around the end of the month and beginning of the month, that have a certain bias as well? That's monthly seasonality. There might even be intra-month seasonality if there's like, I don't know, the middle of the month, but I don't personally look for those. It's also holiday seasonality. That's not present on everything. That's probably more present on speculative assets like US equities and certain other markets, like maybe the Indian Nifty 50. But on a lot of commodities, you may not find this, except maybe around the major holidays like Christmas and New Year holidays. And then what about gap ups and gap downs? So not every market has a non 24-hour ish trading schedule. So a lot of futures, this won't really be a thing because most of the bars will connect. But on a lot of markets that are not trading 24-ish or 23 hours, basically, you will see gap ups. And so there may be behavior around that you can examine. And then there's indicators. I would generally pick indicators that you can test easily and quickly and try to avoid getting into the trap of continually trying to tune the indicator until it does what you want. Either the indicator works for that market and you can find out pretty quickly that the indicator is built for that market, or it doesn't. And I don't want to dive too much into this. Go ahead and see the September video for a more deep dive into how to use indicators in order to build strategies for a particular market. And then, of course, there's the bias effects that are just pure statistics. Certain markets tend to have certain biases on even days, some based on odd days. There's also this concept of time left in the month. So this kind of goes back to the monthly seasonality, where some markets, if there's like less than, I don't know, 10 days less left in the month, 10 trading days, then there are certain bias effects, and that's called TDLM, time trading days left in the month. And you can investigate some of that. There's also intermarket strategies that you can look at. So last month I talked about the correlation with gold, and so there's always multiple things at play. Um, Other ideas that I haven't touched on in this series are walk forward. So I mentioned in the beginning of the series to explore Kevin Davies' Strategy Factory course, and I still recommend it, even if you end up not being a huge walk forward trader. And to be honest, I'm not. I think a lot of the principles in his course are a good add-on to this foundation. But whether you decide to trade walk forward type strategies or not is really up to you. I don't um, I think the best way to put it is that different strategy types are suited to different styles of traders. So you could be a trader who doesn't trade any sort of seasonality. You could be a trader that doesn't really trade intermarket strategies. Like I personally don't really trade those, even though I showed one last month. And you could also be a trader that only trades walk forward strategies. So Kevin Davey is a trader who's won the Futures World Trading Championship, and he only trades walk forward strategies. And I think there are certain types of strategies that only are viable or primarily only viable if you are updating them constantly with walk forward. But I'm the kind of trader that doesn't like to constantly update or maintain walk forward parameters. And so I don't trade that many walk forward strategies. But I still think it's important in your journey as a trader to at least explore that, because almost every trading platform advertises the feature of walk forward optimization, walk forward matrix. And I think it's good to learn what those are. And there's an infinite number of, well, theoretically infinite number of different ideas you can explore that I haven't covered in this foundation. For example, you could look into cycles. That's kind of related to seasonality, but that's more like John Ayler's work of certain cycles and patterns that happen after like 81 days for certain commodities. I think those cycles are closer for the or more accurate for the seasonal, more like the commodities that typically have seasons when they're harvested and when they're grown, different supply and demand cycles. But for me, the big one is having a strategy lab, and that's something you can put together from the title of this video. And most of what I do is a combination of loose data mining to kind of understand the behavior of that market. So rather than individually thinking about breakout and exhaustion, mean reversion, or even seasonality, I typically use data mining to put that together. And then I later add filters to try to see if I can turn it into a tradable strategy. And then I put it in incubation. And that's basically what I described here. So you identify some sort of loose effect. This could be a theory that you have. It could come from data mining. And I say loose because I know a lot of people, they want to immediately get to a tradable strategy as quickly as possible. I care less about that because I think that there are many edges that exist in every single market for a number of reasons, but not all of them are necessarily tradable. And I like to capture them and record them and think about them. Even if they're not currently tradable, it's possible that over time they do become tradable in a certain way. But it's good to capture them because you may have a revelation later on. You might one day, I don't know, just be thinking about it and or even thinking of another strategy, and then that gives you this sort of aha moment for an effect that you wrote down in the past. And I think that's one of the defining moments of I'm now an algo trader because when you have it, and I think every algo trader does have one moment like that for the first time, and then you put together something that was just a loose, untradeable effect into something that you can actually send to incubation. I think that's a really cool feeling. So, I identify some sort of loose effect. I try to find one good filter for it, either based on like standard deviation, maybe consecutive closes, maybe volatility or statistical effect. And then if that turns it into something that produces a back test that I would have traded, then I send it to incubation. And because of the nature of the strategies that I like to create, I usually will incubate for at least 2 years. And it's not truly 2 years, it's more like I will I will reserve at least 1 year of data to not be used in the back test, just to serve as a out of sample. And then I'll use 1 year that hasn't happened yet and then use that as a true out of sample, and then take those two and combine them to form the 2 years out of sample. And then I check, does the performance more or less match the back test, like the equity curve? Does the equity curve in the out of sample look like it just continues the equity curve from the back test? Because if it does, then there's a very likely chance that this effect still exists and it's worth trading. And if it doesn't, then I probably overfit it somehow. And that's really the best way to gauge overfitting because you never truly know if you've overfitted or not. And then this last part here is, you add it to your your portfolio for that market. I mean, there's different ways to test portfolio. What I usually do is for each market. So let's say SPY for gold, for crude oil. I actually just have one strategy that combines all of the strategies that I'm trading live, and I use that one actual strategy to control position sizing. That way, I'm not trying to manage position sizing between a bunch of different strategies. And so you take the strategy that has now passed incubation and you add it to your portfolio strategy for that market, and then you retest and see, does adding that strategy actually improve the performance of that portfolio? And sometimes it does, and sometimes it doesn't. And so to understand why it might not, let's say you have a mean reversion strategy that already is in your portfolio, and then you develop another strategy that is mean reversion, and a lot of its entries just happen to be coinciding with the winning entries of your existing mean reversion strategy. But the losing strategy or the losing trades tend to be different. So then if you add it to your portfolio, then all you've really done is just add more losers to your portfolio because the winning trades, for the most part, already overlapped the existing winning trades of your existing mean reversion strategy. So that's an example where you might have developed a strategy that might be too similar to an existing strategy. And so really all you're doing by adding it to your portfolio is just adding more losers to it. And so that's a case where I would personally not trade it live and just put it back into incubation, because there is a possibility that my existing mean reversion strategy starts to perform worse, but this other mean reversion strategy that's in incubation starts to become uncorrelated and might be worth adding later to replace the previous mean reversion strategy. So that was a bit of a handful, but hopefully it made sense. So let's go ahead and dive more deeply into what it means to have a process. And this is really the mindset here, which is that we want to focus on quantity over quality. I think that many algo traders starting out, they focus on trying to develop these really high quality strategies. And there is a part of the journey that you have to go through where you're not able to generate ideas quickly, and so you do get stuck in that sort of like, I don't have many strategies because I'm trying to perfect the existing ones, and I just want to have this database of only good strategies. And you want to be careful of that because it's better to have a massive bank of loose effects and strategies that aren't quite good enough, and then later be able to go back and, like I said, maybe you have a revelation down the line and you go back to a strategy that wasn't good enough and you find a way to add a filter or something to it that now makes it worth incubating. And so you can't spend all your time just focusing on trying to perfect these strategies before you add them to the bank. You really just need to focus on quantity because that will create the quality. So now if we look at my edge development process I talked about in the previous slide, and we go into more detail, um, I'll be honest and say that I don't spend that much time thinking about new strategy ideas. So in step one here, I mentioned in 1.4 that I only theorize occasionally. And that's because for the most part, I already get my ideas from a number of sources. I data mine overnight on a pretty powerful PC, uh, and that gets me numerous loose strategies. And by loose, I mean like profit factor above one, like profitable, but may not be profitable enough to be worth trading. But that gets me the loose edges that I'm looking for that I can later tune. And then, of course, I'm part of many trading strategies or trading communities of algorithmic traders. So, Unger Academy, Kevin Davies community, and the algorithmic guys. Now, if you look these up, you'll see that they're all paid communities. But um, that's just kind of the nature of it, is that the higher you go into algo trading, the more exclusive it kind of gets. I still recommend that you join Kevin Davies' Strategy Factory. I will also be releasing kind of a revamped trading section for our own Discord community, and in the Patreon, I'll be including a new tier where you can get a strategy from me every single month. So that'll be a way for you to also get uh, already vetted strategies and ideas. And so you really just want to do what you can to get number one out of the way. Like the idea, you don't want to be in a position where you're struggling for ideas. You need to have just so many ideas that you don't have enough time to investigate them all. And so that's step one. And that's also why I've never responded to any of you who have messaged me saying, hey, do you want to swap ideas? Because the answer is no. If you're asking that question, you don't have many ideas, whereas I have too many. So step two is usually you have to convert whatever code for whatever idea into the trading platform. And I've actually created a chat GPT conversation that I've trained pretty extensively to where I can just paste the code either from my data mining software or easy language from one of these trading communities, because a good number of them do use TradeStation. And then my conversation with ChatGPT will automatically convert to Power Language. And then what I do is I take my filter list and optimize the multi-charts. So I have a library of patterns that I have found to be quite reliable, and it's personally curated. So ideas are like standard deviations away from, um, I don't know, the price on the daily chart. It could be, is there volatility increasing on the daily or some other higher time frame? Have we had consecutive closes? Like you may not want to continue going long if there's already been like 3 bull bars in a row on the daily chart. So there's just a personally curated library of patterns that I have found to be very effective in taking a loose edge from step one and filtering out a good number of losing trades. And the question that you're probably going to ask here is, well, how do you know that you're not overfitting? And the truth is, I don't. And I honestly don't worry that much about overfitting. That's where you want to get, is to the point where you're not agonizing over overfitting. Instead, you're just sending it straight to incubation. And incubation, I've talked about a little bit in the previous slide, but I want to comment on something here that is really important. And the first is that you really have to give the full amount of incubation time in order to evaluate the strategy properly. The big mistake I see people do is they put a strategy in incubation, or they say they do. And let's say, you plan to incubate for 1 year. I like 2 at least, but let's say you choose 1. And then 6 months have passed and you're like, I'm going to go check out that strategy in incubation. So then you go look at it and you decide that you don't like the performance in the 6 months, and then you take it out and you toss it. The problem is that you really do have to give the full you, and ideally a certain number of trades that is statistically relevant. So at minimum 30. But that's the mistake you want to make sure you don't do, which is you look at it and discard it even though you haven't given it the full incubation period. Because there are a number of strategies that I put in incubation where as soon as the incubation period begins, it immediately goes into drawdown. But it may take the last 6 months to fully turn around and make new equity highs. So just be careful of that. And then step 5, I talked about in the previous slide. I have a single strategy for every market that contains all my strategies for that particular market. And then if I have a strategy that is past incubation, then I add it to this overall market strategy, super strategy, and then I retest with the back test. And that will tell me, does this new strategy actually improve my portfolio, or does it just overlap too much with the existing strategy? And then a good number of strategies fail that test. And so even though they passed everything that's shown before, they still don't end up getting traded live. And then I just put them back into incubation. And then the last thing, of course, is to check correlations, and just make sure that I haven't, or at least update, the correlations I have between different strategies trading different markets. And I didn't really put that as a step here, but that's honestly a pretty quick test that I do. And it's not hard to see if one set of strategies for one market that you're trading is starting to become too correlated with another set of strategies for another market you're also trading. And so what you end up with is just a lot of strategies in incubation. So this is just a clip from Discord showing all of my DAO future strategies, or not all of them, but this is showing just the ones in incubation. Um, and this is not public in the Discord. I've been thinking about what to do about this. Obviously, I'm going to go through a good number of these once their incubation period is over and evaluate them. And if they pass, then I'll publish them. But I just have hundreds of strategies in Discord that are just incubating, waiting for 2026 to begin, after which I'll start going through them and then deciding, okay, does it look good for the 2 years of incubation because they were developed up to 2023? And then, we have 2024 and 2025 for the out of sample period. Or do I feel like they didn't take enough trades in those 2 years and I need to just put them back? So that's kind of, the place that you want to get to. And that's the reality of an algo trader, that you just want to be sitting there with just way too many strategies and you know having that problem of not enough time to check them all very quickly. So let's go ahead and talk about a the main workflow that I use. So here is some visual examples. But first I want to address the fact that you really do have to data mine loosely, because for the reasons I said earlier is that everyone wants it easy. They just want to have something build all their strategies for them, and then they just click some buttons, and then they just start printing money. But you're going to be more successful if you start to actually learn about the markets that you're trying to trade on. And data mining is really good at teaching you those things, because it'll show you that particular market, the top results might just be mostly mean reversion, or they might mostly be breakout strategies. So there's just a lot of things that you learn from mining loosely. The second point here I think is really important, which is if you have certain entry conditions consistently show up, then you might consider adding that as a filter just for that market. So I wouldn't add it necessarily to my library of filters, but for that particular market, I'd probably write it down. For example, in this series, we've seen a lot of ideas where we just add the filter of, or at least the entry condition, the IBS, internal bar strength, has to be low. And that's actually something I learned from data mining, that a low IBS tends to improve every single US equity strategy. And that's not true for other markets, but it is true for US equities. So this is kind of what it looks like here for Build Alpha. I use both Build Alpha and Strategy Quant X, but this is, I think Build Alpha is the cheaper one and arguably just as powerful. I like some of the features of Build Alpha more than Strategy Quant X, and then there are certain Strategy Quant X features I like more than Build Alpha, and so it's just a matter of understanding the strengths and weaknesses of both. But here you can see that we're going to be mining for a long strategy in SPY. We're going to have a max hold time of 3 days, just because I don't want to be mining a strategy that holds for like 2 weeks or a month or any sort of time period where I might have to actually compare its performance to buy and hold because it's just in the market too long. And then I have a custom selection of entry and exit conditions used. So then I only mine for an hour. Typically, for daily strategies, I think it's fine to mine for even as short as like 10 minutes, sometimes 30 minutes. But for any sort of intraday, I typically mine for a lot longer, usually overnight. But here you can see that um, the top result here, or top 5 results here, all have the same filter, which is that the close must be less than or equal to the low of 3 bars ago, and that the open must be greater than the 5 EMA. So all of the, I would say the top 5 results, top 6 results, all had this entry condition. They had different exit conditions, but it seems like this is a very strong entry condition. So really, you can't go wrong with any of these, I would say. I just picked the top one just after sorting by profit factor. I do want to address a question that someone will likely have, and that is, would I take all of these that have the same entry condition and check them all and incubate them all just because they have different exit conditions? And the answer is yes. Normally, I would. I'm not going to do it in this example, but normally I would take them all and then find the one that I think is most stable and put that in incubation. And that can be time consuming. But for this example, we're just going to take the top one here. So the first thing I like to do after finding a loose effect is try to identify a filter that can be used to exclude most of the losing trades. So Build Alpha has a built-in robustness check feature where you can test by seasonality. So here I just check, okay, show me the seasonality for even days and odd days traded by this strategy. And you'll see, and I should mention, this is based on the entry. So if the entry day is even or odd, this is shows you kind of the trade result of that particular entry. And in a previous video, I showed you that this market, the US equities market, typically is more long biased on even days. And for this particular strategy, we don't see a different bias between these sorts of days, which means that this strategy is pretty effective on both even and odd days. So that sort of seasonality can't be applied. But that is the first robustness check I like to find, because if I can just find a simple, okay, even or odd filter removes most, or not, I shouldn't say most of the losing trades, but just a significant number of losing trades for me to just use that filter, then I'm done. And I can send it straight to incubation. But in this case, like you see, both of them have a pretty similar equity curve. So now I have to export to easy language and Build Alpha, Strategy Quant X. Most of these data mining tools, they do have built-in export to other platforms. So here is an example of the Build Alpha export to easy language, which is TradeStation's scripting language. By the way, you can set up a TradeStation account for free, but in order to not be hit by maintenance fees, you have to move at least 5,000 into the account. That can be a bit much for people. But I think that if you are serious about algo trading, you probably should have at least 5,000. If you've been watching this series and taking note about all the different times I've talked about how our community has other ways to make money besides trading, then that should be a pretty easy hurdle for you to clear. So anyway, you take this, which has a lot of boilerplate, and then you don't necessarily have to remove the boilerplate, but I like to. So I have a ChatGPT conversation where I simply have ChatGPT turn it into something that reads a little bit better. And so you put it in on the left, and then I get the version on the right that goes into multi-charts. And then I have to set up a chart in multi-charts. So one thing to understand is that for my optimization, I use a 5-minute data one. And for this strategy, since we're mining on the daily, I use a daily chart data two. So even though all the signals are being calculated on the daily chart data two, all of the execution is being done on the 5-minute data one. And you don't necessarily have to do that for your workflow, but my workflow uh, is for better or worse tailored to where I can only do the filter optimization on intraday charts. So this is the first goal is to simply add the strategy to multi-charts, check the performance report without any optimization, and see if we get a similar equity curve, which means that we've basically reproduced the strategy results from Build Alpha over into multi-charts. And here we see that, for the most part, you've got a pretty similar equity curve. There's going to be some differences in results just because of different data feed, but if you get similar results, then I think that just means that the strategy is more likely to be real, since a different data feed also kind of confirmed the results, or at least got you similar enough. So then now I do an exclusion filter optimization. So I mentioned I have this pattern of filters that are based on a number of things. I've got some patterns that are that check standard deviation on the daily, some that check volatility, some that check consecutive closes. And so what I do is I just run the optimizer over those patterns to try to find one that will exclude a good number of losing trades in order to ultimately produce a better strategy. And one thing that people are probably going to ask is, well, if you're adding more filters, doesn't that make the strategy less robust because you're just making it more complex? And so my rule for that, well, there's two things. First is that, again, we don't truly know if it's overfit. You can argue all day about what the definition of overfit means in terms of actual implementation versus just the generic definition term. But you really just need to send it to incubation and then check the out of sample performance. Because even if it looks overfit, if it's still continuing to perform out of sample, then you don't want to be the guy that's like, oh, I never traded this because it looked overfit, even though it's continued to perform for years out of sample. So I don't worry about overfit that much. I simply just send it to incubation. Now, over time, over the years, I have discovered that certain entry conditions and some of my previous exclusion filter patterns have generally led to more overfit strategies or ones that failed incubation and I end up removing them. But for the most part, my rule in the filter optimization is I want to see at least 50 trades in the backtest per entry condition. So the prior optimization or prior data mining, we found two entry conditions. And now that we're trying to optimize to find a exclusion filter, this will add a third entry condition. So you'll see here that my filter settings are that I need at least 150 trades. So we've gone from 100 trades minimum now to 150 because we're adding exclusion filter. That's the third entry condition. My minimum profit factor is at least 1.75. And then the max intraday drawdown filter kind of doesn't matter, but I just left it in there because that's my default. And so we find a number of different results, and then I just sorted by profit factor and then chose the best one here. And again, when I say best, this is a pattern. Like here you see the best exception pattern is number 54. And you know 53 and 52, 55 aren't on there, but you can really evaluate these the way you would typically evaluate a parameter because all of these optimization numbers actually are a different pattern in my library of patterns. And so you're not looking for a stable range, you're just looking for which pattern makes the most sense. So here we have to ask that question: does the exclusion filter make sense? And so I go into my library of uh, exclusions or exception filters. I use those terms interchangeably. And uh, pattern number 54 is just the range of yesterday was greater than the range of 2 days ago. And so since this is an exclusion filter, then we're basically saying that if this is true, then the strategy doesn't enter a trade. Even if the other two entry conditions are met, the range of yesterday was greater than the range of 2 days ago, then we don't trade. So another way to think about it is this has to be false while the other two conditions have to be true. And if you think about it, it's saying that, well, if the range of bars, if the range of price has been expanding recently, then there's increased recent volatility and that we should not trade because increased volatility is associated with increased risk. So it makes sense to add this as an exclusion filter. But again, all of my exclusion filters at this point are personally curated over time, over years. And if there's going to be a pattern that I end up removing, it's not because I decided that I don't like it anymore. It's more so that it's a common thread in a number of strategies that failed incubation. And then I might think about it and be like, all these strategies that failed incubation were using the same exclusion filter. Maybe this exclusion filter should just be removed. So that's really the way I think about it. Again, it's really about the process rather than sitting here and arguing all day about semantics, like it overfit, because it reads like it's overfit. Um, and this is really important because if you've already solved step one in the process, which is having a constant source of ideas, and you're wondering, okay, but how do I get into this workflow where I'm just constantly cranking out strategies and sending them in incubation, what you're probably missing is a personal list of filters. So, just to recap, number one is you need a way to identify edges that achieve a profit factor greater than one. Doesn't matter if it's a profit factor of like 1.1. You're looking for loose edges, and you need a way to source these ideas quickly and constantly. And then two, if you don't have a pattern uh, or like a library of filter patterns, then you should definitely create one. And I might release the one I use to the community, or at least think about ways in which to incorporate my learnings into the community better. I'll have to think about that over time. But my goal is to accelerate the people that have decided to take the strategies I've taught in this series. I mean, if you're concerned about the cost of the Patreon, um, but you have actually taken these strategies and run them live, you've definitely made enough money to cover the cost of the Patreon. But if you do join the community, then it's very likely at some point you will get access to this pattern of filters, or at least something. It may be a limited set. I think it kind of depends. I'll have to think about it more, but um, I really want to empower people who are actually going to make it in trading, rather than people who are just watching videos and thinking that consuming more content is somehow making progress, even though it's not. And so, if you don't have a personal list of filters, you're going to need one as an algo trader. And then that combination is what will generally produce things that you can send to incubation. And then, once you've got just hundreds of strategies sitting in incubation, you're getting this flow where every time a new year begins, you're like, well, I've got like hundreds of strategies to evaluate over the course of this year to decide whether they passed incubation or not, whether to include them in my portfolio, whether they actually made my portfolio better. And then you're trying to squeeze in time to also develop new strategies to send to incubation to later check in future years. So that's the ideal place to be. So there's another optimization that you can make, and I don't always do this for every strategy, but this is looking for a day of the week to exclude. So this is kind of like it's kind of a play on the day of week seasonality, which is where you look to see if there's a certain bias then with a specific day of the week. But in this case, you're looking for, is there a specific day of the week where the strategy consistently loses? And the most important thing here is that this day of week exclusion has to make sense. You can't include it just because it removes a few strategies. You have to include it because you don't include it just because it removes a few trades. You have to include it because it removes a lot of trades. Because it probably means that there is, in fact, some sort of day of week seasonality going on that your strategy probably should not be trading. The only danger with including a day of week exclusion is that the day of week seasonality might shift over time. And so you just want to be aware that if your strategy is starting to perform more poorly, maybe rerun this day of week exclusion on just the out of sample data and see if it makes sense to just remove this filter entirely. But for now, I just stick to the rule that I mentioned earlier, which is that for every rule in the strategy, I need to have at least 50 trades in the backtest. So if we add a day of week exclusion, then we now go from 150 trades in the backtest to a minimum of 200. And so, again, yours can be higher or lower. There's no magic number, but it should be at least 30. So here we found that day of week number 3. So multi-choice 3 is Wednesday. Sunday is 0. If we exclude all trades on Wednesdays, all entries on Wednesdays, I should say, we still have a little bit over 200 trades and an improved profit factor. So I'm fine including this. It looks like not trading on Wednesdays bumps the net profit higher just slightly, but it removes about 50 trades from the total trades, but still keeps us a little bit above the 200 minimum threshold. So that's what I've decided to include. We've decided to add this filter, but again, with all day week filters, you do want to, whenever you're looking at the strategy after incubation, um, consider, potentially removing that filter if it didn't perform well after incubation, because this is always kind of a, I don't know, this is a tricky filter to include. So this is the strategy that we sent to incubation, and our in-sample backtest was from 2007 to 2023. So a couple bear markets, a couple crashes. You see all the entry conditions shown there, um, and of course the exit conditions of the original strategy, which I didn't touch on, but essentially there's only two. One is the RSI2 is between 40 and 50. That's data mined, and I don't fully know how to explain it because between 40 to 50 is typically ranging behavior, or you're just in the trade longer than 2 days because we have a max hold time of 3. So now we need to look at the strategy after incubation. So I mentioned earlier that normally I use 1 year that I set aside as out of sample data, and then 1 year that hasn't happened yet. For this strategy, we're coming up on the end of 2025, so this second year has happened, so we can look at it. So we got to update the chart again, the range, as you see here, SPY from 2024 to 2025. And then we look at the out of sample results, and this is what they look like. So personally, I would say incubate 1 more year because we only got 22 trades in those past 2 years. But the equity curve does look reasonable because even though we started off with some losing trades, it recovered and continued to make new equity highs. So if we look at this and then go back and look at this is the equity curve of the strategy we sent to incubation up to 2023. Now, if you were to take this out of sample equity curve and just attach it to the end of what we saw previously, I'll go back really quick. You have to ask, does it look like it just continues the equity curve, or does it look like the equity curve suddenly takes a dramatic turn the moment we entered out of sample? And I would argue no. Like, yes, we had some drawdown, but look at look at the majority of this equity curve. It looks like it does just continue the prior equity curve. So I would say yes. So far, this is what I want to see in out of sample. My only concern is that I typically like to see at least 30 trades in the out of sample, and we don't have that. So I would actually incubate 1 more year. So give it 3 years of out of sample. But again, this goes back to a point I made earlier about how you can't just take a strategy that you sent to incubation and then look at it 6 months later and then toss it out because you're like, oh, well, this strategy isn't performing well in incubation. You have to really give it the full incubation period because if you were to look at this strategy for only 6 months, you might only see trades up to like trade 7, which looks like the strategy consistently seems to be losing, and you would completely miss trades 8 through 22 if you tossed out the strategy. So that's just something to be aware of. This part I don't typically do because, to be honest, I chose TradingView because it has a free plan and it's accessible. So for you guys that are wanting to get in algo trading and watching this series, that's why I chose TradingView. I don't typically use it that much. Other platforms like multi-charts and even TradeStation provide more advanced features and processing power. But I did take the liberty to convert this back into PineScript, and I'll provide the PineScript in the pinned comment in this video. But the other advantage of this is it gives us a third data feed. So if we put this back into TradingView, then what you see here is with the TradingView data feed, we're able to more or less replicate the results. And I drew bars around 2007 and what I believe was the end of 2023. I'm not entirely sure I nailed that correctly, but you can see for the most part that the equity curve is pretty close. And so that's what I want to see is like, okay, across 3 different data feeds, we got similar results. So I think I can reliably trust the results of this strategy. And as you can see, the out of sample 2024 2025 also continues to go up. in the TradingView history. So again, um, I'm showing this to you, my full process, at least the data mining workflow for the first time. So it might seem like there was a lot of work involved here, but for evaluating a strategy or at least a loose edge that was data mined, sending it through the filter optimization, and then deciding whether to discard it because I couldn't get it to a point where met my standards, or I was able to get it up to where it met my standards and put it in incubation. I've cut that down to around 45 minutes for a single strategy. And I typically um, do one strategy a day. So I spend about an hour every day just focusing on either sending a strategy to incubation or deciding to bin it, um, or looking at an existing strategy that's now out of incubation and then examining its impact on portfolio. So, you just kind of get into a lifestyle of being an algo trader. And it goes back to what I said earlier, which is that you don't learn how to trade, at least not as an algo trader, but rather you learn how to be a trader. And you got to get into this point where your ideas are constantly coming and you're able to test them and then send them to incubation and then check them later out of sample and just live that. It doesn't have to be huge time commitment. It can just be an hour every day, not even every day, honestly. It could just be, whenever you have an hour on certain days, and you just get into that flow. And then what you'll find is you'll just have this portfolio that's trading all sorts of markets, all sorts of edges, and that's really where you want to be, in my opinion. Um, that's something that you can maintain for arguably the rest of your life, and I find it fulfilling. And hopefully this series has been insightful and kind of given you a lot of different ideas of different types of strategies, as well as showing you what a algo trader's process actually looks like for continuing to maintain the sort of lifestyle moving forward. I'm going to make another video before the end of the year, or at least I hope for the end of the year. It might actually be next year, where I go through all of the strategies that I present in this series and we look at them out of sample. So, like the first strategy that was shown in January, I'll look at what your results would have been if you decided to trade them from February all the way through December. And then the same thing for the strategy in February all the way down. And then I'll also talk about kind of the future of the community as of the end of 2025 slash beginning of 2026, kind of where we're taking things. There's a lot of income streams out there besides trading, and I'm really excited to uh, be able to dive deeper and vet some of the ones I've been exploring recently and be able to present those to the community. Because I'm a firm believer that if you really have what it takes, if you can take these strategies and implement them, you can more than cover the Patreon membership fee. And then once you get into the Patreon, you learn about all these other ways to make money. Then you realize it's not just about diversification within trading, but it's about multiple income streams that are uncorrelated with each other. And that to me is true diversification, or just diversification within diversification within diversification. And it helps smooth out the returns because at the end of the day, no matter how much diversification you do with trading, it's still going to be volatile. And that's just something you can't know until you're really trading live and into the thick of it. But yeah, hopefully this series has helped you. And if you haven't joined the community yet, I hope that you're able to take these strategies, run them live, and that will, again, like I said, more than cover the Patreon fee. And in the Patreon, you will find an unbelievable amount of information and just different ways to make money. So, thank you for watching this series. Stay tuned for the recap that's coming next. And hopefully, one day I'll see you in the community.